Welcome back to my channel, FiscalVoyage. My name is Felix. So in this video, we're going to talk about a oil company that I'm sure you guys have heard of or seen in your neighborhood. But first, I recently created a free ebook on 5 quick metrics to look for before investing in the dividend company. The description has a link for the free download, so make sure to check that out. So the company we're going to talk about today is Valero Energy Corporation. This company was recommended by Drick and Alan. Thank you guys for both suggesting this company. I really appreciate your support and thank you again, and I hope you comment and let me know what you think of this video. So if this is your first time visiting my channel, make sure to hit that subscribe button because I like to do stock analysis of companies that you guys recommend. Watch towards the end of the video because I provide a fair value price as well as my recommendation to determine if it's a buy, hold, or sell. And in this video, I'm going to go through the cash flow statement of the company to show you that I think the dividend is pretty safe at a high rate of 7.07% currently. All right, here's the stock analysis on Valero Energy Corp, ticker symbol VLO. The company is a Fortune 500 international manufacturer and marketer of transportation fuels, other petrochemical products, and power. The company owns and operates 15 refineries and approximately 6,800 retail and branded wholesale outlets. So let's look at the fundamentals for Valero. The revenue grew at 3.1% from 2010 to 2019, so that's a compounded annually, 3.1%. Net income had an outstanding rate of growth of 25.1%, and the credit rating for the company is BBB, so that's good, investment grade. Operating income at 8.3% this 10-year period, and earnings grew at a very great rate at 16.2%. However, the past 5 years, if none of you are aware, the commodity of oil prices has been dropping a lot for the past 5 years or 3 years, and so earnings for the company has been a negative 11.4% because the net income is affected by the commodity prices. So this is very volatile company to invest in, just FYI, but we'll go over that more in this video. Net income, as you can see, negative 11.7% in that 5-year period. So it didn't grow that 25% for the past 10 years. So you can see a dramatic change in net income. Revenue, however, did grow at a nice rate for the past 5 years at 5.4%. So fundamental continues. 2019, the company earned $5.70. Net margin for 2019 was only 2.2%. So most oil company net margin is very tight. And actually, this is lower compressed versus 2018 of 2.63%. And for the last quarter, it was even tighter because, of course, I don't know if you guys are aware of, the oil prices hit negative for a short period of time there. If we look at return on equity, 11.1%. That's about average for the company in the low mid-teens for the past 5 years. Current dividend is very nice at 7.07, and I'm going to talk about more about the dividend shortly. 5-year dividend growth rate at 27.9%, and the most recent increase was 8.9% in January of this year. So the company has been growing dividends very nicely. And with that, the dividend payout ratio right now, which is normalized earnings for the past 3 years. So I took the past 3 years adjusted earnings and divided them by 3 and used that as the normalized earnings for the year. And we get a dividend payout ratio of 65%. However, if I were to use the earnings based on 2020 expected earnings, the payout ratio would be over 380%. So it wouldn't be covered based on the earnings for 2020. But I think the company is going to be fine with the dividend. I don't think they're going to cut the dividend because they just paid out the second quarter as well as the third quarter announcement for dividend. So I don't think the company is going to cut the dividend, and I'll go over that shortly. And the company has been growing dividends for 9 consecutive years. The most recent cut actually happened in the financial crisis in 2008, 2009. But I don't think they're going to cut the dividend this time around. The 5-year dividend yield average is 3.7%. So you almost get double the current yield versus the 5-year average. So that's very attractive there. The balance sheet, debt to cap at only 36%, so that's good, especially for this size of a company. Current ratio of 1.31, that's okay. Exxon, I think, is lower, and same thing with Chevron, so this is a little better than both of those big companies. Debt to equity is very reasonable. I like it. It's 0.61, so the debt to equity ratio is real good. Interest coverage, this dropped versus 2019 interest coverage, but right now it's at 2.92 times. And the price to book ratio of 1.22 versus a 5-year average of 1.6. So that's a good indicator that may be undervalued based on the price to book ratio. So let's go ahead and look at the cash flow statement so I can show you some things here. All right, so this is Valero quarterly report, which was filed on 4/29 for the period ending March. Their next quarter report should come sometime during the end of this month. But let's look at this quarter report at the cash flow statement, which is not this one. It is this one here. As you can see here, the company had a net income loss of 1.7 billion. And if we look here, this right here had an adjustment, which is the value of the oil adjustment, the oil price fluctuation. So they had an adjustment here. This is a one-time adjustment. As you can see, last year at this quarter ending, they didn't have this adjustment. So, you can't do this every quarter because of the oil prices. But if we look here, the company paid out common stock dividends of 401 million. And most of this money, this payout came from, they took some debt insurance, but most of it, as you can see here, net decrease in cash, where they had cash equivalent of 2.5 billion. So right now they have 1.5 billion in cash. So that was how they were able to pay out this quarter or last quarter dividend. I see them, continue. This is basically 3 times the current cash equivalent. So they have basically 3 quarters where they're able to not make any income and still able to pay out the dividend. So that's why I think the dividend is safe for now, but we'll see later on. Let's look at the future outlook now. 2020 analysts are expect earnings to come in at negative $1.55. Like I mentioned, the oil prices had some tremendous downturn beginning of the year. It's been picked up. Right now it's about $40 a barrel, so that's good. Hopefully it'll go up to $50 and $60 by the end of the year, and then a lot of these oil companies will be able to be profitable. 2021 expected earnings $4.15. And just for context, 2019 the company earned $5.70. So this year and next year earnings are expected to be much lower than last year earnings. However, CFRA has a projected annual growth rate of 17%. I don't think that's going to happen at 17%. I'm thinking more about 5 or 6%, and I use that for my dividend discount model analysis later on for the fair value price. But I think they're pretty optimistic here with 17% growth rate for the next 3 years. My dividend yield return model came in and projected total return of 9.1%. Again, mostly of this return is going to come from the dividend because the current dividend yield is 7.07%. So this return model of 9.1%, most of it will be from dividends. The forward PE at 13.4 versus the 5-year average of 14.5. So that means, again, this forward PE is based on 2021 expected earnings. So it's slightly undervalued based on 2021 expected earnings. So just FYI there. All right, so let's look at the fast graph here for Valero. As you can see here, the company earnings is very erratic. It fluctuates a lot and high. You can see here it grew 1,580% in 2010, where it was a negative 10 cents. So I can see the same thing going on, for 2021 and 2022, as you can see here, because I think the oil prices will eventually get back to around $60 to $70 a barrel. So this is why I think later on you'll see my recommendation. But as you can see here, the company does fluctuate a lot based on the earnings, as well as the price follows the earnings. But if we look at the 10-year period here, the price, even though, for example, from 2015 to 2016, the earnings dropped 60%, the price actually continued to raise. Even during the, there was oil price issues during 2017 and 2018. So the company was price accelerated even though earnings dropped. So that's just, tells you the market there. So I think eventually the company will be profitable again in the near future. So you can see here, you can have a total annual rate of return based on current prices at 23.1%, which is very attractive until 2022. But let's look at analyst scorecard. They're not very accurate in the 2-year forward with a 20% margin of error. So I really don't count that too much. But the 1 year is very accurate for the most part. So you can see here, the 1 year should be about flat, but that current dividend is very attractive. All right, let's look at the fair value price here. CFRA has a fair price of $43.29, Morningstar 79, FastGraph at $62.25. This is based on the 2022 or 2021 earnings, and Yahoo has $73 as a fair price, and my dividend discount model analysis is $69.82. This is, I use a 5% dividend growth rate with a 4% for the next 3 years and 4% after that with a discount rate of 10%. And averaging out the 5, we get a fair price of $65.47. Currently, the company goes for $55.48. That means it's undervalued by 18%. That's why I have a recommendation as a buy for Valero at current prices. So I have a buy recommendation for the company, and that's because I think the oil price is going to go higher around the $60 range in the near future, most likely by 2021. The company just recently announced a dividend payment, so they announced already 3 dividend payments for this year. So that's very confident in the management and confidence that I have in the company that is going to continue paying that very attractive 7.07% dividend yield. And once oil prices hit around $60 a barrel, this company is going to be very profitable. As you saw, they had a high net income growth in a 10-year period, but in recent years they had a negative income growth, and that was because in a few years ago cost per barrel was much lower than the previous years. But again, this company does have risk, remember, because it's a commodity oil company, so it relies a lot on the profit of the cost of the barrel. So make sure to keep an eye on that before you invest in this company. Make sure you do your own research. Just because I have a buy doesn't recommend you to actually go and buy it. But I think it's very attractive at current prices if you're an investor looking to invest in oil at current prices. So again, don't forget to check out my free ebook. There's a link in the description. And thank you for watching. And if you're new to the channel, make sure to hit that subscribe button if you enjoy the video, as well as like this video. So I'll see you guys in the next one.